So I'm going to focus today just on what's happened year to date in 2017. So first of all, Asian markets have performed very well year to date and much better than Australia. So for example, the Sensex index in India is up 21% year to date. Hang Seng index is up 27%. Our NTA is up 13% year to date from 96 to 108. And over that same time frame, the ASX 200 is up less than 1%. So Asian markets and EAI's NTA are doing much better than Australia. The other thing I'll add, though, is that the A dollar appreciating is a major drag on this portfolio. If you want a quick and easy way to think of how the FX works, roughly 45% of the portfolio is in Hong Kong, China, and obviously Hong Kong dollar is pegged to the US, so it's like 50% is related to the US. So as the A dollar appreciates, that's negative for our NTA. In local terms, this portfolio is up over 20% year to date. And then lastly, just to look at the chart on the right, we have had a buyback in place for the last year. NTA has gone up, and we've also reduced the discount. So when we first initiated the buyback in September of last year, the discount to NTA was around 19%, which is very big, and that was unacceptable to us. As of yesterday, it's around 11%. We have, passed at our recent board meeting to do the buyback again, a 10% buyback again this following year. So that's going to continue to support the discount. And we're doing a lot of things on the investor relations front to narrow that discount further. 11% is still not acceptable to us. So, for example, we have an upcoming roadshow. We have an upcoming AGM. We've totally redone our website. We've put aside a 2-cent profit reserve because paying a dividend is one thing that we think will be helpful in reducing the discount. So we're really focused on that going forward. Secondly, I'll just talk a little bit about our current positioning, both from a sector perspective and from a country perspective. From a sector perspective, tech is the biggest weighting and it's our biggest overweight. This is something which I always think is important for Australian investors because, 34% of our portfolio is in technology, as ASX 200, less than 2% of ASX 200 is in tech. So if your, clients want exposure to tech, this is a great way to get it. Technologies are our biggest overweight, and then the second biggest weighting is financials. We've had this positioning pretty much since inception. Most of the financials we own are beneficiaries of rising rates in the US, and that's actually been a trade that's worked quite well so far. The last thing I'll mention on sector positioning is that there are times in the past where, we have these three core sectors, tech, financials, and consumer, where 90% or higher of the portfolio has been in those three sectors. Right now, it is more diversified. And the reason for that is, in January, February this year, when the reflation trade was humming, this portfolio underperformed because we didn't own any old economy stocks, like literally not one. And so, when steel is flying and some of the old economy things, particularly in China, are doing well, we underperformed because we didn't own any. So now, there's a lot of thinking that if Trump goes on the road and is pushing tax reform again in the fourth quarter is going to resemble, from a sector perspective, what the first quarter was. So we are not going to make the same mistake twice. We're more diversified now and do hold some old economy stocks. And then secondly, I'll just get to our geographic exposure. Our biggest overweight is India. That has been the same since the inception of this portfolio. We're very positive on the Indian economy and the Indian market in the medium and long term. And our biggest underweight is Korea. So again, that has been consistent since the inception of this portfolio. When we started in 2015, there wasn't this North Korea risk. But, if you remember, EAI is a growth fund. It's a growth portfolio. And in more developed economies in Asia, like Korea and Taiwan, it's much harder to find growth companies. So we've always been overweight, but more recently we've gone even more underweight because of the North Korea risk. There may be some questions about this, so I'll just proactively sort of give you our view. We look at 4 different outcomes. The first is continued brinkmanship and escalation, mostly of words. The commentary earlier, it's gotten very sensationalist about we're going to destroy you, and we're going to, North Korea saying we're going to turn Japan to ashes. It is a lot of sensationalist talk. We think that our base case scenario is that there's just ongoing brinkmanship, but with no outright attack. The second thing that we spend a lot of time thinking about, and which you may not be as aware of, are ongoing brinkmanship, but an increasingly sour relationship between China and the U.S. because of North Korea. So that actually has more implications for our portfolio, because if the U.S. tries to sort of retaliate against China's apparent lack of inaction by putting in trade sanctions or putting in measures that are negative for the Chinese banks, that's a risk for our portfolio. And then the third outcome is that there's some sort of resolution, which we put very close to zero chance on that, but that's a third outcome. And then the fourth is that there actually is an attack. The things that, one of our analysts, Freddie Ho, was in Korea last week, so we have a sort of on-the-ground view. The things that we're watching that would change the probability that there's going to be an imminent attack are threefold. One is if you start seeing U.S. civilians evacuated from Seoul or Guam. So far, you haven't seen that. If you start seeing stockpiling in either Guam or Okinawa, again, you haven't seen that. Thirdly, if you start seeing Chinese or Russian troops along their borders because they think there's going to be a flow of refugees after a sort of attack, you haven't seen that. And lastly, if you start seeing, a much stronger naval presence in the international waters around the Korean Peninsula, and again, you haven't seen that. So for right now, our base case is there's no imminent attack. It's just going to be ongoing brinkmanship and talk. But we have done some things to protect this portfolio because at the end of the day, we are absolute return investors and we want the NTA to go up. It's more important for us to protect the portfolio than to be worried about alpha in this sort of situation. So what we've done, I've reduced Korea exposure, full stop. Cash is slightly higher than before, but not very high. I also have put options on the KOSPI and on other regional indices. One risk about having puts just on the KOSPI is that if there ever was a worst case scenario, the KOSPI wouldn't open and your options would expire worthless, even though there's a lot of value there. So we do have hedges on there. So we think given our base case is just ongoing brinkmanship, we think the portfolio is protected for that sort of outcome. And moving on, I'll just say sort of what's on the horizon for Asia and what we're watching. The first thing is the 19th Party Congress meetings in China. These start on October 18th. We have done a lot of analysis in terms of the standing committee and what's going to change there. Our base case is that, President Xi gets his guys on the standing committee, and then, that's a mandate for him going forward to push his reforms much more strongly. The other thing we're watching is, usually the person who's going to become the next president is on the standing committee for one term prior to that. So we're watching the composition of the standing committee quite closely. There's been some speculation in Australia that following these meetings, Xi's going to have a very, heavy-handed approach to the economy and is going to ram through structural reforms, and it's going to cause a reduction in growth in China, which will have negative implications, obviously, for the Australian commodity complex. That's not our base case at all. Chinese GDP growth is running around 6.7%, which is a little bit higher than their target of 6.5%. We do think that following these meetings and going into 2018, there's going to be more of a focus on structural reform, particularly the supply side reforms. But we don't think that this is going to be a drop-off in growth, certainly no hard landing. And there are a lot of the structural reforms that are going on that are actually, they may be negative for Australian commodities, but they're actually very positive for the companies and the industries within China that are getting reformed. I mean, cement is one example. We do own one Chinese cement company, some of the reforms on the financial side. And I guess those were two that I would highlight. So there's a lot going on in China in the next few months. Secondly, India. This is our biggest overweight, so we watch it very, very closely. Inflation in India is incredibly low. I mean, I've been doing India for 17 years now, and in the olden days, Indian inflation used to be like 12, 13%, and this was normal. Now they're below their lower band. It's running around 2%. It's below their band. We think there's going to be more interest rates coming. That would be good for our portfolio. We hold a lot of non-bank financials with benefit from lower interest rates. And then secondly, in India, they implemented the GST starting on July 1st. This is a huge thing. If you think of how big the Indian economy is and how bureaucratic it is, and just the complexity of implementing the GST. This happened on July 1st, so we're just watching to see what the implications are. The upcoming 2Q18 results, there could be some disruption there in certain sectors like consumer. So we've pared back those stocks and are just waiting to see what happens. Long term, we think this is a very, very positive thing for productivity in India, but in the short term, as in 1 quarter, maybe 2 quarters, there could be some disruption. Thirdly, obviously the whole technology, the FANG and the iPhone complex is something that's very important to this portfolio. So 34% of our portfolio is in tech. About 20% of that is in 4 stocks. So we call them the STAT stocks. This is like the FANG of Asia. So it's Samsung, TSMC, Tencent, and Alibaba. And, we watch FANG very closely for 2 reasons. One, because a lot of the other tech stocks that we own in Asia are Apple supply chain companies. So these would be stocks like Largan, which makes the iPhone camera, Hon Hai, which does all the assembly for iPhones, and TSMC, which does the chips. So we watch Apple very closely in terms of implications for the supply chain. And then also, every time that the FANG stocks start to roll over, the next day the stat stocks start to roll over in Asia. So our base case, we've done obviously very detailed bottom-up analysis. We still like all the stat stocks, but it's just something that we watch, and we're quite positive on the Apple supply chain. And then the fourth thing we're watching is obviously what happens in the US, whether there's a December rate rise. This has implications largely for our financials portfolio. As I said before, the bulk of that portfolio does better under higher rates. And then lastly, the gains that Trump makes on potentially selling this tax reform, and whether that leads to a reflation trade redux as it did in the first quarter this year. And then last but not least, right up there with what's going on in China and with Trump and Yellen, is that Ellerston Capital, EAI and EGI have our annual roadshow coming up. We're going to Brisbane, Melbourne, and Sydney. So if you go to our website, if you're interested in coming, if you have clients that would like to come, go to our website or contact Brian or I, and we can definitely sign you up. We're hoping to get a lot of people out.